I need to be very direct with you today. If Japan's carry trade fully unwinds, there's no safe place to hide. Not stocks. They crash first, not bonds. Japan sells those to fund the exit, not real estate. Rate spikes kill it overnight, not cash. Inflation eats it. Even gold and silver get liquidated in the first wave to cover margin calls. Every single asset class on Earth is connected to this 40 trillion machine. And the machine is breaking. I'm not saying this to scare you. I'm saying this so you have time while most people are still completely asleep. Before we go any further, hit subscribe right now. This channel covers the financial information that never makes it into the mainstream news cycle. Drop a comment below. Had you ever heard of the Japan carry trade before today? Because most Americans have not. And that is the most dangerous thing about it. Watch every second of this. This is the video you will wish you had seen earlier. Let's establish the foundation of what we are actually dealing with. For 30 years, Japan operated the most extreme monetary experiment in the history of modern finance. The Bank of Japan held its interest rate at or below zero. Not 1%, not 0.5%. Zero, and in some periods negative, which means financial institutions were essentially being paid to borrow money. That is not a normal condition. That is a once-in-a-century distortion. And out of that distortion grew one of the most powerful and least understood financial mechanisms on the planet, the yen carry trade. Here's how it works in plain language. A hedge fund, a pension fund, a global bank, or an institutional investor walks up to the Japanese financial system and borrows their 1 billion worth of Japanese yen at essentially zero cost. They take that borrowed yen, convert it into US dollars, Australian dollars, British pounds, or any higher yielding currency, and they invest it in assets that generate returns. American stocks, US Treasury bonds, emerging market debt, cryptocurrency, real estate, tech companies. The trade works because the gap between the zero cost of borrowing in yen and the return on those investments, that gap called the carry, is pure profit. As long as the yen stays weak and Japanese rates stay near zero, the trade is a money printing machine. Not metaphorically, literally. A machine that generates returns with borrowed money that costs nothing. Estimates of the total size of this trade vary depending on how you count it. The narrow definition, direct leverage positions, puts it at around 4 to 500 billion. But when you include Japanese institutional investors, the government pension fund, life insurance companies, and the Bank of Japan's own balance sheet, the total foreign asset exposure connected to this carry trade ecosystem reaches 4 trillion and beyond. Some analysts who include indirect exposure and the full chain of leverage positions that were funded by this cheap yen liquidity put the figure between 20 and 40 trillion in total market impact. Every single dollar of that is now under pressure from a single source. The Bank of Japan raising interest rates for the first time in 3 decades. In December 2025, the Bank of Japan raised its benchmark interest rate to 0.75%, the highest level since 1995. Governor Kazuo stood at the podium and made something clear that the financial world could no longer ignore. Japan is normalizing. The era of free yen is ending, and markets around the world responded immediately. The VIX, Wall Street's Fear Index, jumped. Bitcoin dropped 8% within 2 hours of the announcement as leveraged traders rushed to close positions. The 10-year U.S. Treasury yield surged nearly 6 basis points following the decision. Germany's 30-year bond yield hit its highest level since 2011. These are not small moves. These are shock waves traveling through a global financial system that was built on the assumption that Japan would remain the world's cheapest source of funding indefinitely. And here is what makes the current moment different from any previous warning about this trade. The direction is now undeniable. In January 2026, Japan's 40-year government bond yield surged above 4% for the first time in recorded history. The 30-year yield climbed nearly 30 basis points in a single session to roughly 3.9%, also a record. The trigger was Japanese Prime Minister Sai Takaichi announcing snap elections and pledging to suspend the consumption tax on food to win votes. The bond market looked at that fiscal loosening and immediately repriced Japan's entire debt trajectory upward. The U.S. Treasury Secretary Scott Bessent sat at the World Economic Forum in Davos and said publicly, and this is a direct quote from the public record, that it is very difficult to disaggregate the market reaction from what is going on endogenously in Japan. The United States Treasury Secretary is publicly admitting that what happens in Tokyo is directly moving American markets. That is not analysis. That is a confession. Now consider the scale of what is actually at stake for ordinary Americans. Japan is the single largest foreign holder of U.S. Treasury bonds in the world. As of the most recent data, Japanese investors hold $1 $2 trillion in U.S. government debt, more than China, more than any other nation on Earth. For years, that money flowed into U.S. treasuries because domestic Japanese yields were pinned near zero, and American bonds offered far superior returns. But as the Bank of Japan raises rates and Japanese government bond yields rise, that calculation changes. When domestic yields rise, Japanese institutions face a fundamental choice. Keep the money in American bonds, earning a rate that no longer looks as attractive after hedging costs, or bring it home. The industry calls this repatriation, and Goldman Sachs has already modeled what happens if that process accelerates. A scenario where Japanese institutions shift from buying $4 billion of U.S. treasuries per month to selling their $4 billion per month represents a $96 billion annual swing in demand for American government debt. Their $96 billion of buying pressure that disappears and flips to selling pressure at a moment when the United States is already running a $2 trillion annual deficit and desperately needs foreign buyers for its bonds. What that does to U.S. mortgage rates, corporate borrowing costs, and the American housing market. That is exactly where this story becomes personal for every single person watching. So now the foundation is clear. The carry trade was built on 30 years of free money from Japan. It grew into a $4 trillion ecosystem of global leverage, and the Bank of Japan is now systematically removing the foundation that held every single piece of it in place. But to understand why 2026 is genuinely different from every previous warning about this trade, and there have been warnings going back 15 years, you need to understand what actually happened on August 5, 2024. Because that single day was not the crisis. That single day was the preview. And what it revealed about the fragility of the global financial system should have made every front page on Earth. It did not, which means most people watching this video are about to hear it for the first time. On August 5, 2024, the Bank of Japan raised its benchmark interest rate by just 15 basis points. Not a full percentage point, not even half point, 0.15%. That is the smallest meaningful rate move a central bank can make. And the result was one of the most violent single-day market dislocations since the 2008 financial crisis. Japan's Nikkei 225 crashed 12.4% in a single session, the steepest one-day drop since 1987. The VIX, Wall Street's fear gauge, exploded to 65. The S&P 500 fell 8% in 3 days. Bitcoin dropped 20% inside 48 hours. The Mexican peso, the Australian dollar, the Brazilian real, currencies across the world were hit simultaneously as leveraged positions began unwinding everywhere at once. One analyst at a major asset management firm called it a market Armageddon. Another said it was a massive global carry trade unwind that lit the fuse. And then within 24 hours, the Bank of Japan blinked. It signaled it would not raise rates further amid market instability. And markets snapped back just as violently as they had fallen. Here is the most important sentence in this entire video. The August 2024 episode represented an estimated 10% unwind of total carry trade positioning. 10%. The markets nearly had a cardiac arrest from 10% of the trade, unwinding in a disorderly fashion over 72 hours. The Bank of Japan is now on a path to raise rates to 1% by the end of 2026. That is not 10% of the trade unwinding. That is the complete elimination of the carry incentive that built the entire position in the first place. The question serious analysts are now asking is not whether the rest of the trade unwinds. The question is whether it unwinds in an orderly, controlled way over months, or whether it unwinds the way August 2024 did, except at 5 times the scale. And the answer to that question depends entirely on one variable that nobody fully controls: the speed of yen appreciation. Right now, the dollar-yen exchange rate is sitting around 150. Technical analysis of positioning data identifies the critical levels with alarming precision. At 145, the first major stop-loss layer triggers. Approximately 500 billion in carry trade positions begin closing automatically, pushing the S&P 500 down 3 to 5%. At 140, institutional risk limits get breached, forced selling accelerates, and the S&P drops 8 to 12%. At 135, full panic mode, margin calls cascade across leveraged portfolios globally, and the S&P falls 15 to 25% over 2 to 4 weeks. At 130, the scenario requires coordinated emergency intervention from the Federal Reserve, the Bank of Japan, and the European Central Bank simultaneously. These are not predictions invented for a YouTube video. These are the actual trigger levels being tracked by the quantitative desks of major financial institutions right now in real time, as the yen sits at 150 and the Bank of Japan signals it is not done hiking. Now, here is where the story becomes directly personal for every American who has a mortgage, a 401k, or any money in a savings account. The mechanism that connects Japanese monetary policy to your financial life runs through one specific channel, the U.S. Treasury market. Japanese institutions are the single largest foreign holder of American government debt on the planet. They're 2 trillion, more than China, more than any other country. For years, that money flowed into U.S. treasuries because domestic Japanese yields were pinned near zero, and American bonds paid far superior returns. But here's the math that changes everything. When a Japanese institution buys a 10-year U.S. Treasury bond and hedges the currency risk back to yen, meaning they protect themselves against the yen strengthening, that hedge now costs them negative 157% annually. They're paying to own American government debt on a currency-hedged basis. That is not an investment. That is a guaranteed loss, which means Japanese institutions face a stark choice right now. Either they keep their 2 trillion in U.S. treasuries unhedged and exposed to yen appreciation, destroying their returns, or they sell. And if they sell, the United States government loses its single largest foreign buyer of debt at the exact moment it needs to sell more of it than at any point in peacetime history to fund a 2 trillion annual deficit. What happens when the largest buyer of U.S. government bonds stops buying and becomes a seller? The answer is the same answer that has applied to every bond market in recorded history. When demand falls and supply stays constant or rises, prices fall and yields rise. When treasury yields rise, mortgage rates rise. Every single 30-year fixed mortgage in America is priced off the 10-year treasury yield. A 1% rise in treasury yields translates directly to roughly a 1% rise in the average American's mortgage rate. At a moment when the housing market is already frozen because rates are too high for most buyers to afford, that is not a headwind. That is a wall, and it does not just stop at mortgages. Rising treasury yields raise the borrowing cost for every American corporation, every leverage buyout, every corporate bond refinancing, every small business credit line. The yield on the 10-year treasury is the single most important price in the American economy. And Japan, a country most Americans never think about, is sitting on the most powerful lever connected to it. The carry trade unwind does not announce itself. It does not send a calendar invite. It does not appear on the news the morning before it happens. It appears in a currency move that most people are not watching, triggers a margin call that most people have never heard of, and lands in an ordinary American's financial life as a mortgage rate that suddenly became unaffordable, a 401k that dropped 20% in 3 weeks, and an economy that froze while the television anchors were still debating whether it was serious. That landing and how close it actually is exactly what comes next. So now the full picture is coming into focus. The carry trade was built on 30 years of free money. August 2024 showed the world what 10% of it unwinding looks like, and it nearly broke global markets. The Bank of Japan is now raising rates with no intention of stopping. Japanese institutions are sitting on 1.2 trillion of U.S. government debt that is becoming increasingly unattractive to hold on a hedged basis. The 10-year treasury yield is the most important price in the American economy, and Japan holds the lever connected to it. But here is where this story shifts from analysis to action. Because understanding a risk is only half the equation. The other half is understanding what the two possible paths forward look like, and what ordinary Americans should actually do depending on which path materializes. Path 1 is the orderly unwind. This is the scenario that serious analysts who reject the catastrophe framing are arguing for right now. In this path, the Bank of Japan moves gradually. Governor Kazuo raises rates in careful, well-telegraphed increments, 25 basis points at a time, spaced months apart, giving leveraged carry trade positions time to close in an organized fashion. The yen appreciates slowly. Japanese institutions rotate out of U.S. treasuries gradually, and the U.S. government bond market absorbs the reduced demand without a violent repricing. Global markets experience elevated volatility throughout 2026. The kind of volatility that feels uncomfortable but does not become a systemic crisis. In this path, the carry trade unwinds the way a slow leak deflates a balloon rather than the way a puncture does. Painful, drawn out, but survivable without a crash. The argument for this path is that the Bank of Japan watched August 2024 unfold in real time and blinked within 24 hours. It knows exactly how fragile the global system is. And the last thing it wants is to go down in history as the institution that triggered the next global financial crisis. Path 2 is the disorderly unwind. This is the scenario that keeps the quantitative desks at major institutions awake. In this path, something external forces the speed. An oil shock driving global inflation higher, which is already happening, forces the Bank of Japan's hand faster than it planned. A political shock in Japan, like the snap election and fiscal promises that already sent 40-year bond yields to record highs in January 2026, removes the market's confidence in gradual normalization. A currency crisis in a neighboring Asian economy creates a contagion effect. Or simply, the yen hits 145 against the dollar. The first major stop-loss layer triggers, or 500 billion in automated carry trade positions begin closing simultaneously, and the feedback loop takes over. In a disorderly unwind, the sequence is not managed. It is mechanical. Margin calls force selling. Selling forces more margin calls. The VIX explodes the way it did on August 5, 2024. Except this time, the Bank of Japan cannot blink because the underlying fundamentals have changed too much for them to credibly reverse course. In this path, the S&P 500 drops 15 to 25% in weeks. U.S. Treasury yields spike. Mortgage rates jump. And the Federal Reserve, already dealing with an oil shock and a weakening labor market, faces its worst possible scenario simultaneously. The honest answer is that nobody knows which path materializes. Anyone who tells you with certainty that this ends in a controlled soft landing or a violent crash is selling something. What serious analysis tells us is that the probability of a disorderly unwind has increased meaningfully in 2026 compared to any previous year because the Bank of Japan's own credibility now requires it to continue hiking even if markets become volatile. That is new. That is different from 2024. That change in the policy reaction function is the single most important variable in this entire story. So what should Americans actually do with this information? Not panic. Panic is always the wrong answer and always the most expensive one. But there are 5 specific postures that financial analysts who track this risk are recommending right now for ordinary investors. First, reduce duration risk in bond portfolios. Long-duration bonds are the most exposed to rising yields driven by Japanese repatriation. Short-duration or floating-rate instruments provide significantly more protection in a rising yield environment. Second, examine international diversification. The yen carry trade unwind historically strengthens the yen against other currencies. Japanese equities and yen terms have been performing strongly as the domestic economy normalizes and corporate governance reforms take hold. Third, understand what is inside retirement funds. Many target date funds and balanced funds hold significant exposure to the exact assets. U.S. momentum stocks, long-duration treasuries, emerging market bonds that face the most pressure in a disorderly unwind. Knowing what you own is not optional, it is the minimum. Fourth, maintain genuine liquidity. Cash is not sexy. Cash is not generating 10% returns. But cash is the one asset that allows an investor to act rather than react when dislocations create opportunities. The investors who had dry powder in August 2024 were buying while everyone else was selling. Fifth, watch the yen. The dollar-yen exchange rate is now one of the most important numbers in global finance for American investors. If it moves decisively below 145, that is the first warning signal that the disorderly scenario has begun. It is a number that trades freely and publicly every second of every trading day. There is no excuse for not watching it. Japan committed to investing $550 billion in the United States by the end of Trump's presidential term. The relationship between these two economies is deeper and more intertwined than at any point in history. That is both the risk and the reason for optimism. Deeply intertwined systems have powerful incentives to stabilize each other. The Bank of Japan does not want to destroy American markets. The Federal Reserve does not want to trigger a Japanese fiscal crisis. The U.S. Treasury Secretary is already watching. The coordination mechanisms exist. The only question that matters is whether the political will to use them moves faster than the markets do. The 40 trillion machine is not broken yet, but it is bending. And the people who understand that, who watch this video, who know what the yen-dollar rate means, who understand what a margin call cascade looks like before it happens, those are the people who are positioned to protect themselves and their families from whatever comes next. The people who did not watch, who stayed asleep, who assumed this was someone else's problem. They are the ones who wake up one Tuesday morning and cannot understand why their 401k dropped 20% and their mortgage rate is unaffordable. History does not warn the unprepared. It bills them. Subscribe right now. Share this video with one person in your life who has any retirement savings at all. Drop a comment below. What is your biggest concern after watching this? Because this channel exists for exactly this reason. To cover the financial realities that never make it into the mainstream conversation before they arrive in your life, whether you are ready or not.